The Bank of Canada just cut rates down to 2.25%, a quarter point rate drop. Yeah, you already know that. Let's get into what actually matters. They immediately said, "We're done." But the bond yield spiked up immediately in response, and your variable rate payment just dropped about $15 per 100,000 if you're on adjustable. Now, this wasn't the rate cut that was coming to save you. This was a desperate last move to stop a recession that's probably at this point already here. But here's what they're not telling you about why this might actually be the rate cut and why that could be terrifying for the overall economy at this point right now. Look, I'm going to cut through the noise right away. Yes, the BOC cut the rates by 25 basis point this morning. And yes, your variable rate mortgage just got cheaper. But this is not all good news, contrary to what people think. Because what happened immediately after this news was announced? Well, one thing, bond yields jumped right away up. And you know what that means is that fixed rates are probably not only at their bottom, but they could be swinging back up really quickly. And the reason that they're done cutting is not because the economy is doing very well, it's because they've run out of ammunition while the economy is basically burning on fire down around us. Now, let's talk about the practical stuff. What does a 25 basis point cut actually mean if you have a variable rate mortgage? Well, for every $100,000 borrowed on a variable rate, assuming you have an adjustable payment, you'll save about $15 per month on an average 25-year amortization. So if you got about $600,000 mortgage, that's about $90 per month savings. And we are very happy if you are a variable rate holder because for the last year and a half, you've seen rates cut from 5% on the overnight rate down to 2.25, which represents most variable rates today hovering in the mid to high 3% range. Yay for you guys. Now, as mentioned before, your variable rate probably dropped from 3.8 to 3.6, assuming you're getting a pretty decent discount off of prime or depending when you got it. And that adds up to a pretty significant, almost $1,000 per year savings on a $600,000 mortgage. But here's the catch. The Bank of Canada basically said, without saying it, we're done unless things get substantially worse, which is possible. Those are basically their exact words. They said they want to see what they said exactly was that based on where the current policy rate is, it's at about the right level to keep inflation near 2%, if I could speak. And the bond market heard that loud and clear with bond yields basically jumping up because traders know that no more rate cuts mean fixed rates stop falling. And in fact, they're probably going to go back up based on this information. So if you're one of those people that were waiting for lower fixed interest rate mortgages, you better move fast because Oxford Economics is already forecasting fixed rates will climb significantly over the course of 2026, which is interesting because beforehand they were basically holding flat. So very quick turn of events based on this morning. Now, let's talk about why they cut rates because it's not what they're saying publicly, it's based on what's happening behind the scenes. But the official line is that trade uncertainty and structural damages from tariffs require accommodation. But here's what Governor Macklem actually said, and this is a direct quote. The weakness we're seeing in the Canadian economy is more than a cyclical downturn. It is a structural transition, which means permanent, not temporary. This is from Macklem's speech from 2025, October 29th in the morning. And here's what Macklem said about growth expectations. He's forecasting only 0.5% growth in Q3, pretty close to zero in his words, and 1% in Q4. He said these numbers are not going to feel good. And well, we know that near zero growth for the rest of 2025, some scary stuff, folks. But the real kicker, he said it's more than a cyclical downturn, it's a structural change. The US has swerved to protectionism. It's harder to do business with the United States. We know that. Structural means, again, this ain't going away anytime soon. Look at the actual economic data. Reacting to GDP, it contracted to 1.6% in Q2, and that is not a slowdown, that is a contraction. Unemployment hit 7.1% in September, which is the highest since 2016. People are losing jobs, and these are recession level numbers. But here's what's really terrifying job losses in August alone were $65,500. That is 1 month. And the bank admits that job losses continue to build in trade sensitive sectors. And hiring has been weak across the entire economy if you haven't been paying attention. I mean, basically, the labor market is completely deteriorating and it's accelerating, meaning it's going faster. The primary measure that a bank looks at, which is core inflation, CPI, median, and trim, if you want to know the details, it's still stuck at 3.2% and 3.1. Those numbers are supposed to be at 2%. So they're cutting rates while inflation is still high, which means the cost of the food at the grocery store is going up. And yet we're accelerating the potential likelihood that this could continue to happen. Basically, the government is more scared right now of a recession, which means more people losing jobs, than inflation, which means things going up in price. And they admitted it. They said monetary policy cannot undo the damage caused by tariffs. It cannot restore the economy to the pre tariff, so the pre Trump path. And then he said something even more scary. Unless something else changes, our incomes will be lower. Our standard of living as a country is going to be lower than it otherwise would have been. That is big. Basically, the governor of Canada explicitly said Canadians are going to be permanently poorer. Not what you want to hear from your Bank of Canada's governor. I'm going to repeat that. He said, he just basically told you your standard of living is going down, not temporarily, permanently, unless something else changes, which he can't control. Holy crap. All right, let's talk about what this means as it relates to resale and housing market. Now, while the Bank of Canada was announcing this rate cut, the construction industry was releasing data that can only be described as apocalyptic. And I'm trying not to hype things up too much, but I can't not at this point. There's like a parallel crisis in housing supply right now. That's not a good thing. In September 25, across the greater Toronto area, which is one of our primary benchmarks, biggest city in the country, 7 million people, Canada's economic engine, only 438 new homes sold. Only 438 new homes sold. That's down 29% from last year and 80% below the 10-year average. A normal September would see like 22 to 2,300 home sales. That's wild. And condos in the entire, again, I'm using GTA as a benchmark, but entire GTA, it's like 155 units sold. In Toronto proper, 53 sold in Canada's largest city. Now, remember, Toronto is not Canada. We've got Vancouver, we've got Calgary, we've got Edmonton, we got Montreal. We have all these different cities that I have not even mentioned or talked about, but that is a big benchmark and that is something to pay attention to. But this isn't just Toronto. Vancouver is at a third of normal activity. Calgary is showing troubling signs despite being the like affordable alternative. It's not going as fast up as it was before. It's really flatlining. This is a national issue, not a regional issue. Now, we have to keep in mind that we have a supply crisis. So this doesn't necessarily mean that these values and price points will go down forever, but the confidence in the market is shaken. It is definitely an industry warning of long-term consequences of housing affordability, jobs, economic activity. Basically, they're predicting 100,000 jobs lost nationwide. And the kicker is in 27 and 28, so 2027, 2028, when this inventory finally clears, we'll have virtually no supply coming, which means that time is when the market expects house prices could explode. So we could just go like this and then rebound right back up. I know some argue this point, and I don't care if you do, because this is just looking at what the data is suggesting. Now, CoStar's Group chief economist Carl Gomez said something that should make every real estate investor a little bit nervous. He said, one major implication is that for Canada's struggling real estate sector, the road to recovery this time may not be driven only by cheap borrowing costs, which was largely the driver of the sector over the last decade, which basically means the playbook that worked for 15 years is essentially dead. Said that real estate isn't just coming back because rate dropped. The entire buy because rates are low model was fundamentally broken. Now, the reason they're saying that cheap money won't save real estate this time, and the fact is, this is probably going to shock some real estate investors or anybody waiting for the market to come back immediately, is the truth is that cheap money isn't going to save it this time. We're going to break conventional wisdom around this. Carl Gomez also said that they're the biggest real estate data firm in North America. He said that for Canada's struggling real estate sector, the road to recovery this time may not be driven by extremely cheap borrowing costs, which is largely the driver of this sector over the past decade. And then he said, we have long argued that this easing cycle would be different than the past emergencies, such as the financial crisis and COVID, where the bank cut rates to 0%. Now, if we think about that, for 15 years, the real estate strategy was pretty simple. Wait for rates to drop, then buy. The 2008 crisis, rates went to zero. Real estate boomed. COVID, rates went to zero. Real estate was nuts. This time, they've cut 275 basis points and new home sales are down 80%. This matters because rates are not producing the house sales the way we would typically expect. Now, another source says that while an overnight rate decrease is welcome news, it may not be enough to spur significant movement. In many of the regions, we've seen housing prices decline 10 to 20%, but those prices are still expensive because of the income levels not having kept pace. And that's despite the fact that we are the highest affordability in Canada that we've seen in 5 years. And the scary part, or the brutal truth, is that this isn't just interest rates, it's incomes and it's jobs and it's confidence. This is where we mention the fact that the rich get richer and the poor get poorer. This is a structural damage that Macklem keeps talking about. I can keep it going here. Real estate startup CEO Robert Saunders said buyers are still contending with a soft job market, and the resale activity has flattened while new construction is being driven primarily by rentals, not ownership. The entire market structure has changed, which is another reminder of the fact the market fundamentals are leaning towards a nation of renters. Basically, they're saying that they're building less homes. There are going to be less homes available. People can't afford as much. They're not going to make as much, and you're going to basically force you into rentals. How do you feel about that? I can't say I feel awesome if I was in that position. So you're waiting for rates to drop to 2% or 1.5% to make sense or to feel like you're ready to make a move, and it's not happening or not likely to happen. I don't predict guarantees. 2.25% today. Inflation is still hot underlying, and they just told you they're done. The market, the BOC, everybody is basically saying this is, relatively speaking, the bottom. Now, let's talk about the most important part of the announcement, what they didn't say. Like, CIBC's Andrew Grantham said it basically like this: on our base case assumptions that the economy starts to gradually recover and that a trade deal is reached to lower some sectoral tariffs and reduce uncertainty, today's move would be the final one. It's basically a major bank economist calling it the last cut. And a lot of the major institutions see the cutting cycle over. Now, some are still a little bit more open to the bank cutting another 0.25%. BMO had mentioned as much, but TD is basically saying this is it. We're at the bottom. Basically, we're done unless things fall apart. And the bond market understood that immediately, moving up. Again, everybody seems to think variable rates go down, fixed rates go down. Not the case here, folks. And here's why they're basically stopping. They've already cut 275 basis points. That's 2.75%. The policy rate is now 2.25, which is below the bank's own estimates. And this matters because we're in stimulative territory. We're now dropping rates so much that people can stimulate or borrow more money at a low cost. At 2.25%, they're providing economic stimulus, and it's like an extra stimulus. And they can't justify another rate drop right now with inflation being above 3%. So, I mean, ultimately, to scan through this to get to the next point, basically, the concerning part is that with multiple major banks are forecasting rate hikes in 2026, with Scotiabank being a little bit more aggressive, saying 2.75 by late 2026, and National Bank saying 2.5. They think inflation is going to force the BOC to reverse course. Now, these economists can only really say so much, and the truth is, BMO is the one that's on the outlier on the down end. We're going to see these economists come out and say different things over the course of the next 30 days as more data comes down. But expectations, I think, need to be reset. I mean, this could very well be the bottom, and we just have to be open-minded for that. And so, I mean, the key point for most people, what does this mean for variable versus fixed rates? The million-dollar question. If the bank just cut rates and they say they're done, what do you do with your mortgage? Well, we know there are decisions behind just taking a rate. So let's keep that in mind. And we have a framework. If you haven't seen the Prepare framework on how to make a decision on fixed or variables, which is proprietary, just send me a DM on Instagram. My link is in the bio before. Prepare, Prepare to Instagram, and I'll send it right over to you. In the meantime, if you're already on a variable rate around 3.5% after today's cut, you probably need to know this is likely as low as it gets. This could be the floor. And fixed rates ranging from 3.79 to 4.29% on average. That's only a 25 basis point spread from the bottom between variable and fixed, and that's pretty tiny. So the variable rate advantage is still there slightly, but it's not a significant one unless you believe that we continue to see rate drops happening. Now, if we do see hikes happen in 2026, your variable rate could be back at 4 or 4.25%. which would be on par with what a lot of fixed rates are today. I mean, my take right now is you've got kind of the pick of the litter. You could go any direction with fixed rates and choose not even just the cheapest rate. You could choose the best product, the best term, and they're all going to be within a 0.25% right now. And you could lock in for 3 years and see your money just barely win, but still be pretty strong. The potential savings from variable rates could be, $15 to $30 per month for every $100,000, which is minimal, but you do have the benefit of flexibility of a variable rate. And if the market does fall off a cliff, then you're going to win. So I think you have to just be conscious on the math about going with a fixed or a variable after you've decided which product makes the most sense. It may not be as beneficial as it has in the past. So if you're buying a property right now, my feedback is that confidence tends to return before affordability does. And the shift in sentiment can gradually basically thaw activity. But the key is like, can optimism hold if prices start rising faster than incomes in the next year? Basically, any demand recovery could price out buyers all over again. And it's interesting to note that there are a few different speculators and economists suggesting the same thing, which says that these rate cuts aren't going to fix the psychology, but the market could come back very fast based on the understanding that the supply levels are still extraordinarily low and rates are down. It's just that the psychology of buying is like, we're not just going to buy because rates are lower. We're going to buy because now is the right time. And there's a whole bunch of people on the sidelines waiting to do so. So here's the thing. Don't expect falling rates to save you. What you see is probably what you're going to get for the next 12 months at least. And the bigger picture, what this says about the economy is a little bit scary. Basically, bringing it all together, because the rate cut, the guidance, and the construction collapse, they all kind of tell the same story. The economy is in serious trouble right now. The bank cut rates by 275 basis points in 18 months. Variable rate mortgage rates have dropped from 6 to 3.5%. Fixed rates have come down significantly, which is awesome for payments, is awesome for families. These are all good things. But in the meantime, new home sales are collapsing. The construction industry is facing massive job losses. We're not building enough supply, and everything being built is rentals. It tells you that the interest rates were never actually the problem here. The problem is our trade policy, the tariffs, the uncertainty, collapsing confidence, an economy that's like smaller than we thought it was, or it was a couple of years ago. And Macklem knows it. Monetary policy, which means rate drops, is not going to fix the market, especially when it comes to tariffs. So what concerns me the most is that they've already played most of their cards. The policy rate is at 2.25%, which is the bottom end of the range. And if things get much worse, and we might see 50 to 75 basis points cut before they hit the lower bound. That will be 2 or 3 more basis cuts. But what happens after that? Because then rate drops aren't going to help the economy. Monetary policy can't fix aluminum, steel, cars, and it can't help companies find markets. We have a bigger picture problem in our hands there. They're basically at a point right now where they're stuck between a weak economy and stubborn inflation. And that's the scenario that the banks hate the most. Ultimately, to get to the end of this, I'm not here to panic you, but even though it sounds like it, but I want to give you the unfiltered truth. Today's rate cut to 2.25% is going to help variable rate holders. Yay. Whew, that's real money. And if you're on a variable, enjoy it. But that's probably it based on what the BOC said, unless things get worse. And you might feel like that's the case. Bond yields jumped because fixed rates aren't falling anymore, which is crazy because it means fixed rates could actually rise. And the economy, it's in trouble. But don't forget this. Everyone keeps saying the same thing from an outside perspective, that right now, 2026 up until 27, 28, it looks bad. But then there won't be a lot of new builds, and we'll have a supply crisis back on our hands. Look, if you're looking to lock in a mortgage rate because of a renewal or refinance or purchase, you probably want to do it soon, specifically if you're looking at a fixed rate, because in 6 months, based on what's happening today, depending on how it goes, this could be really the bottom of fixed interest rates. And if you're watching the economy, just trying to figure out what's going next, keep your eyes on the November 17th deadline. Basically, wondering what's happening with CPI and inflation is what is going to impact the market. Now, this was data heavy, so hopefully you've been able to capture as much information as possible. Now, if you want the real headlines and you want to understand more of this, no false bullcrap, just the data and what it actually means, I'll do my best to spin a little bit more of a positive outlook in the future. But at the end of the day, I want you to hit subscribe for an honest analysis of Canadian real estate. Drop a comment. I'd love to know, are you on a variable or are you on a fixed? Did you just lock in? What are you planning on doing? And if you're someone looking to make a decision, don't forget, send me that message regarding the Prepare framework. I'll get it out to you so my team and I can help you advise on what strategy makes the most sense. See you on the next one.